Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is March 13th, 2025. Good morning, everyone. I hope you're all feeling energized and ready to tackle another exciting day in the markets. Let's jump right in.
Today's market activity is a mixed bag, and it's one of those days where we see some declines across the board. Over in the United States, the S&P 500 is trading at approximately 5,542.509, down around 0.928%. The Dow Jones Industrial Average is not far behind at roughly 40,946.121, marking a decline of about 0.81%. The Nasdaq Composite is feeling the pressure too, sitting at approximately 17,384.187, down around 1.218%. And if we shift our focus to smaller cap stocks with the Russell 2000, it's roughly 2,000.761, down about 1.25%.
Turning a bit to the cryptocurrency space, a market that's always full of surprises, Bitcoin is trading at around $80,899.75, down roughly 3.3%, while Ethereum is trading at about $1,872.228, dipping by nearly 1.88%. These numbers are a stark reminder that despite all the innovation and enthusiasm in the crypto space, volatility remains a constant companion.
Now, taking a step back, what does this tell us about overall investor sentiment? While a drop in these major indices might cause some concern, it's important to remember that mild corrections are a typical part of market cycles. There's a rhythm to these movements, often driven by a mix of profit-taking, cautious positioning amid global uncertainties, and a collective reevaluation of near-term prospects. As investors, when we see moves of this magnitude, it's worth asking ourselves if these declines are driven by underlying issues or simply profit-taking after recent gains. There's always an opportunity hidden in these gyrations, provided you know where to look.
Let's now dive deeper into the broader market trends that have been shaping investor decisions lately. Over the past several weeks, we've observed that investors are increasingly focused on balancing risk and reward. With the economic outlook remaining uncertain, many are hedging their bets by shifting allocations among equities, fixed income, and alternative investments. There's a growing consensus that while traditional blue-chip indexes continue to face headwinds, sectors driven by technological advancement and innovation are still showing promise despite periodic setbacks.
For instance, despite the overall decline in our major indexes, tech giants remain a hot topic. One of our recurring headlines, Microsoft has been the worst big tech stock lately. Here's why it may become the best, has been circulating repeatedly. Now, this might sound contradictory at first glance, doesn't it? How can a stock that is underperforming possibly transform into a market leader? Well, the answer often lies in the details. In this case, the narrative centers around Microsoft's recent rigorous discipline on its artificial intelligence spending and the company's adept pivot toward prioritizing efficiency over reckless expenditure. In a time when consumer spending might be slowing down, Microsoft appears uniquely positioned to weather a consumer downturn, potentially emerging as a leader when its counterparts find themselves struggling to adapt.
It brings to mind a bit of market humor. Sometimes our underdog picks end up being our white knights. I always say that the market is a bit like a roller coaster. Sometimes you're up, sometimes you're down, and sometimes you're just clinging to the safety bar wondering what comes next. Microsoft's story is a prime example of knowing how to ride out the dips and potentially turn a so-called worst story into a best one over the long haul.
Moving on to another story rattling around the market corridors, ClickHouse has announced the acquisition of HyperDX. For those of you keeping an eye on tech and infrastructure, this is a significant development. ClickHouse, known as the company behind what many are calling the fastest analytical database in the world, is doubling down on its commitment to innovation. By acquiring HyperDX, an open-source observability platform built on its very own technology, ClickHouse seems set to reinforce its leadership in data analytics and infrastructure. This move isn't just about absorbing a competitor, it's about integrating cutting-edge technology that will enhance data visibility, boost performance monitoring, and ultimately deliver faster and more reliable analytics solutions. It's a strategic play that reinforces the company's reputation and sets the stage for future growth, particularly in an era where data speed and accuracy are paramount.
In the world of financial stocks, Wells Fargo is also making headlines. Analysts have been buzzing about Wells Fargo recently, with RBC Capital emerging as one voice in the chorus that sees the stock as a good entry point. Despite the broader trend of financial stocks remaining under pressure, Wells Fargo appears to be carving out a niche of stability. It's being touted as a bargain, especially when compared to its peers that are grappling with more pronounced sell-offs. It's an interesting scenario where one might argue that despite the general banking sector's struggles, there are pockets of opportunity for investors who are patient and buy into the fundamentals. It's reminiscent of the old adage, be fearful when others are greedy and greedy when others are fearful. Wells Fargo seems to be offering that kind of contrarian value proposition.
Now, pivoting to an intriguing twist in the automotive and political spheres, another headline capturing attention is Trump just bought a Tesla, but many other owners are selling their Musk-made EVs. What's going on? This story is particularly fascinating because it highlights seeming contradictions in consumer behavior. On one side, you have a high-profile purchase by someone who has made headlines for his unorthodox approach to business and politics. On the other, a wave of used Teslas flooding the market suggests that there might be broader concerns about the desirability or long-term prospects of the electric vehicle space. Is it a cautious move by everyday investors, or is it an indication that the market is rapidly evolving and forces us to ask whether prominent figures are setting trends or merely acting as anomalies?
And let's be honest, if a former president can drop a couple $100,000 on a new car, it makes ordinary challenges like deciding between a sedan or an SUV seem almost trivial in comparison.
So far, we've reviewed 10 distinct news stories. Multiple takes on Microsoft's shifting fortunes, the strategic acquisition by ClickHouse, investor optimism surrounding Wells Fargo, and the intriguing developments in the automotive world with Trump and Tesla. It's interesting to see these topics coming up repeatedly. Repetition in the news often signals that these are not just passing fancies, but are integral parts of a larger market narrative, one that demands our attention as we consider our own portfolio strategies.
Now let's step back and consider some detailed sector analyses. In the technology sector, the persistent focus on artificial intelligence and big data remains unstoppable. Microsoft's recent reorientation toward disciplined AI spending is just one case in point. The tech sector at large is witnessing an inflection where long-term investments in innovation appear to be rewarded even if short-term profits take a minor hit. Contrast that with the story from ClickHouse, which points to a growing emphasis on data observability. Both stories underscore that even in times of overall market pullbacks, the continuously evolving tech landscape is filled with opportunities. This isn't to say there aren't risks. The rapid pace of innovation means that companies must continuously evolve, and any misstep can lead to wider ramifications. Yet, for those willing to ride the ups and downs, tech can offer some of the most compelling growth stories.
When we shift our lens to the financial sector, the narrative becomes just as nuanced. Wells Fargo is being re-examined by analysts who see its current valuation as an attractive entry point. In an industry where policy changes, regulatory oversight, and economic fluctuations are constant, Wells Fargo is showing signs of resiliency and adaptability. It's a sector that demands balance, cautious monitoring of risk, plus a keen eye for value propositions that become apparent in the midst of market turbulence. Banks, in recent years, have learned that trust is as important as profits, and with that in mind, now is an interesting moment to watch how legacy banks adapt to modern challenges, from digital transformation to global financial shifts. And if banks are the backbone of the economy, sometimes a downturn in individual bank stocks is just a reminder that the broader underlying fundamentals have much in common with long-term economic cycles.
As far as the energy sector is concerned, while it hasn't commanded our immediate headlines today, it remains an underlying force behind many of these market movements. Global economic challenges, including shifts in energy pricing and geopolitical tensions, continue to exert pressure on energy stocks. This indirectly affects investor sentiment across sectors. While we might not have a blockbuster energy story in our roundup today, it never hurts to keep your finger on the pulse of global energy trends. After all, even when you're focused on tech or finance, energy is what powers these industries in a very literal sense.
Stepping beyond domestic borders, the global market implications of today's news cannot be overstated. When we observe such moves in major indices and witness bold strategic acquisitions or noteworthy shifts in investment sentiment, the ripples are felt worldwide. International markets are interconnected with the US dollars and, more importantly, with the flow of ideas and innovation. Whether it's a technology-driven acquisition like that of ClickHouse or the cautious optimism around banking giants such as Wells Fargo, investors around the globe are taking note and recalibrating their strategies. It raises broader questions. How will international fintech markets react to trends in the US? Can emerging market tech hubs capitalize on this renewed focus on AI and big data? These are fascinating questions that provoke thought among investors who always look for the next big opportunity.
As an expert analyst, I always like to blend the numbers with some storytelling, not unlike a conversation you'd have over coffee with a trusted friend. I'll tell you, sometimes the market can feel like a never-ending roller coaster with steep climbs and sudden drops. But it's in these volatile moments that some of the best investment opportunities hide. We've talked about Microsoft's dramatic turnaround potential, the strategic moves in tech with ClickHouse, and the resilient yet undervalued stance of banks like Wells Fargo. These stories remind us that even when headlines seem contradictory or conflicting, the essence of smart investing is understanding the details behind the noise.
Now let's get into some expert insights and a bit of friendly predictions. In the short term, I believe we're likely to see market volatility continue as investors digest mixed signals from global economic developments. The slight losses in our major indexes might give way to localized gains if key sectors adjust quickly enough. In the tech space, for example, if Microsoft successfully navigates its disciplined approach to AI spending, it could very well emerge as a leader in the next tech cycle. And if ClickHouse's acquisition of HyperDX pans out, we might see increased investor confidence in data analytics companies that are betting on speed and efficiency. On the flip side, if the broader financial environment continues to feel the pinch, banks like Wells Fargo might see a steady inflow of value funds looking for stability amid the chaos.
One can't help but laugh when market analysts predict that sometimes the best investment is a good sense of humor. I'm reminded of a little joke. Why did the investor bring a ladder to the market? Because they heard the stocks were going to climb and they didn't want to be left on the ground. While it's true that markets can be unpredictable and even amusing in their quirks, the underlying takeaway is to always be prepared to adjust your positions as new information comes in.
Looking forward, the global market outlook holds both challenges and bright spots. Advancing technologies, shifting consumer preferences, and dynamic policy landscapes all contribute to an environment where flexibility is crucial. International investors are likely watching these U.S. developments very closely, as predictive indicators tend to ripple through various international indices. With central banks around the world reevaluating monetary policies based on fluctuating inflation data and slower economic growth in certain regions, the next few months will be telling. There's an exciting interplay between monetary policy, geopolitical stability, and technological disruption that will guide the evolution of both developed and emerging markets alike.
Before we wrap up today's briefing, let's distill a few key takeaways. First, broad market declines across major indexes, including our beloved S&P 500, the Dow, and the Nasdaq, serve as a reminder of the cyclical nature of the market. Even when things seem a bit gloomy, there's always a silver lining if you have a long-term view. Second, while headline-grabbing stories like Microsoft's potential turnaround and ClickHouse's strategic acquisition are capturing attention, the real success lies in understanding the underlying trends that drive these transformations. Third, the financial sector, as exemplified by Wells Fargo's recent performance, offers intriguing opportunities in an otherwise challenging environment. And finally, don't overlook the global implications of these domestic developments. They echo through international markets, influencing strategies and risk assessments worldwide.
As we ponder these trends, I encourage you to ask yourself some thought-provoking questions. Are the current market dips a signal to invest more aggressively in key sectors, or a cue to exercise caution until the dust settles? Could today's bold moves in technology and finance be the start of a larger thematic shift, one that might redefine our investment strategies over the next few quarters? And finally, in the era of comprehensive financial data and artificial intelligence, how will investors adjust their strategies when their information co-pilot Pantheon AI is always a message away?
Thank you for spending your morning with me as we navigated through today's market overview, deep dives into major trends, and the most compelling news stories from the world of business. I hope the insights and expert analyses shared today provide you with a balanced perspective for your investment decisions. Remember, in this fast-paced market environment, staying informed is not just a strategy, it's essential.
This has been your host from Pantheon AI on the PAI Morning Briefing. I'm grateful that you joined me as we broke down the complex interplay of market dynamics, from the decline in major indexes to the intriguing developments in tech and finance. Remember, Pantheon AI is your information co-pilot, here to guide you through every twist and turn in the financial markets.
Join me again tomorrow for another episode filled with fresh insights, new trends, and the occasional market pun to lighten the mood. And as always, feel free to reach out with your questions and thoughts. After all, learning shouldn't feel like a full-time job.
Have a great day, stay curious, and happy investing.
Good.